And now it's my pleasure to introduce our speaker. Brian Moynihan has led one of the world's largest financial institutions, Bank of America, as its chief executive officer since 2010. He came into this role during a turbulent time for the company after the financial crisis of 2008 and was charged with the hefty responsibility of moving the bank forward. Over the past few years, Brian has proven that he is more than capable, turning the company around and even reporting second quarter net earnings up 63%. Brian has maintained that his passion lies in the customer-driven business model of Bank of America. In addition, his philanthropic endeavors have influenced the company to work toward achieving three major public goals: a 10-year, $1.5 trillion community lending and investing goal, a 10-year, $2 billion philanthropic giving goal, and a 10-year, $50 billion goal for lending to and investing in environmental initiatives. We're looking forward to gaining some insight into the man that led his company out of the crisis and learning how he is transitioning to everyday business. Perhaps we will even get his perspective on the economy or on Chicago in particular. So please join me in giving a warm welcome to Brian Moynihan.
Thank you. Good afternoon, Chicago. It's a real pleasure to be here. Thank you, John, for those warm welcome, and thank all of you for giving me the opportunity to speak to you. What I thought I'd do is, before your format's to have question and answers, I'd give you a few thoughts about the economy and try to fill you in on what we see. And I'd basically do three things there. First, I'd talk about the economy that we've seen over the last couple of years, how that sets up, I believe, what the economy will see over the next couple of years. And the third and an important theme is what do we do at Bank of America to help push the economy along. In August, I was on a family vacation, and I'll admit our family has an addiction to going to Disney World, so we were in Disney World. And I'd come back from Europe on a long trip, and I was at Disney walking towards Splash Mountain, and what hit me was a sense of deja vu. And the reason why is in August 2011, I was walking in that exact same place. And if you remember August 2011, it was a time where the EU was going to come apart, Greek exit. The United States was going to default on its debt because of fiscal cliff. China was slowing down. At Bank of America, we just announced major settlements in the second quarter, and our stock was moving around. And in August of 11, I'm walking towards that place, and I was thinking about it 4 or 6 weeks ago. I was walking towards that place, and the phone started ringing off the hook in my pocket. And those of you that are all engaged in business and go on family vacations or carrying your BlackBerries, you know that that's not the best family building moment. So I made an excuse. I had to get a water. I ran off, picked up the phone, looked at it, missed the call, looked at the stock price. We were down 10%. The market was going crazy. And so I called the CFO and said, what's going on? And he started reiterating that the big rumor was next week the U.S. government was really going to get into trouble. And our stock was moving around as a proxy for those kinds of troubles. And so I walked back to my wife, and I looked rather ashen. She looked at me, and she said, what's wrong? And I explained it to her, and she said, you got to get out of here. She said, you cannot be at Disney World if your stock is down 10%. Now, my family has supported me in my job and supported all of us in our jobs, but I tell you, that's something that's never heard before is please go back to work on a weekend on a family vacation. So I did. And as those of you may know, that we then had the Warren Buffett investment the next week, stabilized the company, and it's been good news since then. But as I was thinking about that in August 2013, I really thought, what has changed? What has changed? We still have a European situation that is grinding forward. We still have China, whose growth rate continues to be addressed down a little bit. We still have a United States economy, which is slow growth and working its way out. But what has really changed is every fundamental part of our economy in the U.S., which is the biggest economy in the world by a lot, is in better shape. Whether you look at unemployment levels, down since that time. Whether you look at housing prices, up since that time. Whether you look at consumer or business confidence, up since that time. So you're seeing all that, and that's what gives us the optimism. As we face down what is going on, the U.S. economy is in much better shape. I'll give you a few statistics. Europe is coming out of a recession in most of the economies, or working its way towards coming out of that. The federal budget deficit is now 4% of GDP, not 10% as it was a couple years ago. 60-plus delinquencies in mortgage banking and mortgages are down 35% than they were at that time. Housing prices are up 16% than they were at that time. So we're seeing consumer and business confidence continue to rise. So that's what gives us confidence as we look forward in the economy to come. Now we're going to continue to face some natural and human-created disasters. Natural disasters like the hurricanes, tsunamis that we saw in the last couple of years. Other items that will affect us, the Arab Spring, the changes in the Middle East, of which we're going through another one. Europe will continue to bounce around, and we'll continue to have a fiscal debate in Washington that doesn't seem to want to resolve itself. But because the economy is in much better shape, you're seeing it rebound better. Think of the fiscal cliff debate at the end of 2012 heading into 2013. Think about the market's response to that. It was not as severe as it was back in the August of 2011 framework. So that gives me optimism about where the economy is going. Most people think about the economy, the next question comes up is, what is the Fed going to do? And the one thing I won't do as a regulated bank holding company is try to front run the Fed's ideas on the economy. But I will tell you they are clear. They've been clear to all of us. They're going to reduce QE, quantitative easing, when they find out that they can do it in a way that won't harm the economy. And that's what they've been doing. They're going to exit in a way that will not have any possibility of sending the economy backwards. So if you think about what we see, rates are rising in the long-term rate structure. And as we think about that, we ask our customers and clients to watch what they do. And so what are we seeing as rates have risen, as the Fed has started presaging their exit over the next few months? Mortgage refinancing has slowed down. There's not a question. The volumes of mortgage refinancing are down, applications are down significantly. That's the one hand. On the other hand, home purchase activity is fairly solid and continues to go forward. First-time home buyers have doubled since the beginning of the year. Consumer spending in Bank of America, and we see about $40 billion a month of spending on our debit and credit cards a month, is up about 6% August of 13 versus August of 12. So you can see consumers continue to spend. If you talk to core manufacturing companies and middle market companies around the country, which I have the pleasure of doing, they are in great shape. The impact on long-term rate structure is not heavy on them. Most of them have LIBOR rate, floating rate loans, and that hasn't moved in an iota. Secondly, most of them have had term debt refinanced it to very favorable terms. They're making money, and they're in pretty good shape, so they're ready to help move the economy forward. And for larger companies, the capital markets remain wide open. Witness the transaction that all of us completed for Verizon yesterday, the largest bond financing ever done, in a time when the most uncertainty around fixed income investing has probably existed in our business careers. So that means that the economy continues to push forward. The rate structure move is inevitable. It's what the Fed will ultimately have to achieve as they exit. But the impact on the economy is high in places like mortgage refinance and relatively modest in other places. Now, if you look at short-term rates, the market says rates won't move to 2015. And that's because the economy continues to grow slowly. That slow growth environment and limited inflation risk has led the Fed to hold rates down. And we, like consensus, our economists, like the consensus economists, would expect that that stays through to the summer of 2015. Another factor in the economy that people ask about often is housing. The housing recovery is real. It's been a bright spot for the last couple of years. The data shows that improvement in all the activities, but except for mortgage refinancing. We expect that housing recovery to continue. Household formation is strengthening, up to about 1 million per year. We see that the affordability is still strong. We see in markets like Chicago or like San Francisco, housing is very tight. And these markets, they continue to need more apartments to house people. And we see a lot of purchase demand build up. We also see the inventory of abandoned and foreclosed properties continues to go down. So when you think about the rate structure, you've seen a big movement this summer. You think short rates will stay low, long rates have moved to another level. The economy continues to push forward. And so what's our expectation at Bank of America for the economy over the next year or so? We've seen in the past year 2% growth, more or less. Our research analysts would believe that the growth will improve to 3% next year. I hope they're right. That would be a better place to be. But we've got to keep that in perspective. Each year we've had a prediction that next year's growth was going to be there, and each year as we got to that year pushed out a little further. So we got some work to do. The long-term growth rates in the United States are more predicted to be 2.5% levels as opposed to 3.5% levels that the long-term projections were in the early part of the 2000 decade. So we are optimistic about the economy. We see the corporate sector in great shape. We see that companies have a lot of cash on hands. We see that they're still being cautious, but we see all the fundamentals in much better shape as we move forward from the summer of 2013 and beyond. I will tell you, though, the businesses are still being cautious. I was with breakfast at the Boca Group restaurant this morning. As those of you who have seen our ads, we took one of your Chicago companies and put it in the national domain. We were at the restaurant today with a bunch of business banking clients. They'd be clients with under 50 million in revenue. And everyone to a T said business is better. In some cases, it was booming. And I asked the second question, are you going to hire anybody? Well, we're trying to be cautious. And that's the watchword people have, is caution, and making sure that the demand is still there. But we see that continuing to thaw, and we continue to get better. So the last question I said is, we talked about the economy the past couple of years. We talked about the economy going forward at 2.5% to 3% growth rate. The question is, what do we do at Bank of America to help push it along? Walking around Chicago this morning, and I've been coming here for 30 years since I went to law school in a little school called Notre Dame down the road. You can't but notice this is a city of bridges. And if you think about the role that we play in the economy as a bank, we see ourselves as a bridge between you, our customers and clients, and our capabilities to help you live your financial lives. So our job is to build that bridge, to build it with a great foundation, to build it with strong capital, strong liquidity, to build it with talented people, the 7,000 people we have here in Chicago, and to be less complex and more helpful for you to live your financial lives, as we say, through the power of every connection. When we talk about that, we do that on a national basis, an international basis, and a local basis. So what do we do to help build those bridges in Chicago? We provide a bridge here. That bridge is built by the 7,000 talented teammates we have working in the market every day. Next month, we're going to provide a bridge between this community and the world through our sponsorship and running of the Chicago Marathon. We're going to have some of the most talented runners will come here to show how good they are. And we're also going to have Tim Maloney, who's not the most talented runner in the world, complete the marathon for his first time. So Tim, our market president, good luck. The important thing is, when we just released this, is the marathon generated about $250 million in economic activity in this town last year, and we're proud to sponsor it again this year, and we'll continue to do that. We provide a bridge between small businesses and financing, $300 million of financing in Chicagoland last year. We provide a bridge in helping with the vacant and abandoned houses. 150 houses we've given away over the last this year so far. 150 homes to nonprofits to put back into service, and we'll continue to do that. We provide a bridge between the millions of dollars of philanthropic work we every day, and proudly the 40,000 volunteer hours we do a year in Chicago with our teammates. So that's what we do. We provide bridges. In the city of bridges, our role is to be a bridge between all of you, the capabilities we have to serve, and by building one bridge for every customer, one bridge for every client, we build and help build an economy. That's what we're here for. That's what we're passionately committed to. I look forward to taking your questions. Thank you.
Thanks for your remarks. I understand you had a town hall meeting for your colleagues this morning at the Art Institute. As you took questions from them, what was on their mind?
When you're out with teams that serve clients and customers, the number one question is, how do we keep improving our customer capabilities, from both product capabilities and service capabilities? And what am I doing as CEO to help them become better for the clients? And that's usually what's on their mind. And then they ask about whether the stock price is going to go up. They ask about those types of things because it's in their best interest. But our teammates are in Chicago are fired up, and the LaSalle transaction, even going back to the early days of Bank of America, this market for our team, because of Tim's leadership and the leadership teams, is in great condition right now and doing very well, and we're very happy with it.
So related, I assume you're doing some customer visits and whatnot while you're here. So again, what do you hear from the customers of the bank in terms of either what they want from you or what you're seeing in the marketplace?
Well, I think, so when we think about the customers as an economic club luncheon, what are the customers telling us? And I think if you think about the consumer side, what the customers are telling us is they feel reasonably good. Now, there's a bit of a dichotomy. There's an unemployment issue in the United States that is hard to solve right now because the ability of American business to keep improving and making profits without employing more people is it's been pretty remarkable. So that's an issue that we're going to have to keep dealing with as a country. But from a core consumer spending, as I said before, you have 5.5%, 6% up month after month over the year prior, and people are spending and their confidence up, and they're spending a little bit more on credit, and that's good news. So they're, basically, I think the consumer's in pretty good shape. When you go to the business side, they're in great shape mentally, they're in great shape profit-wise, but the only thing that is universal across the whole country, across the world, is this issue about what could happen next that I can't predict. And because even modest, what used to be middle market companies, even small companies, are now in the global trading, global participation, they are impacted by Italy. And so the parade of horribles they can come up with is a lot longer than it would have been a decade or two ago. And so they're worried about the uncertainty, healthcare law, Washington, fiscal cliff. And so I think if we can keep knocking those things back, the capitalistic spirits will carry it forward.
A moment ago when you were referencing your teammates, you said they always ask you about your stock price. The Bank of America was recently pulled out from the Dow. Why was that, and does it even matter?
I'm not sure they asked my opinion, but and I bet you most of the people in the room, like I did, would have understood it. It's a nominal stock price weighted index. So at $14, we aren't as impactful as Visa at $100-some. So they pulled us out and put another financial service company, Goldman and Visa, had a higher stock price, so the index would reflect the economy more. It is what it is. It's not a big impact to the company what we do.
In your talk a few minutes ago, you touched on housing. Are there lessons that were learned from the last housing bubble that are being applied now, and how do we kind of avoid the next bubble in that regard?
I think the number one lesson from the whole financial services crisis, which was an economic crisis of which the financial services industry got in the middle to help drive, and so there was a core economic issue, and then we're going to reflect that. And because the amount of leverage, we really reflected it. And that's probably the lesson that I think all of us would agree with is you got to keep the leverage not only in the financial services company themselves, but in the system down. And if you look fairly simply from 2007-8 period to now, the financial services system in the United States has doubled its capital and probably doubled or tripled its liquidity. And importantly, the extended financial service system in the United States, hedge funds and others, ability to leverage is way down too, and that keeps the leverage down overall. That's the number one lesson. So how does that apply to home mortgage? Same question. If you do 100% financing, you have a low margin for error. And if you do it on a 30-year, lean into 40 years, it's a huge risk for a long period of time. And I think we all learned that you can't do that. So good underwriting, down payments, inherently a conservatism will stop it. That's what's in the underwriting today. Is it probably tighter than we need? Yeah, but I think that's the number one lesson. Keep the leverage intact, and the rest of it should take care of itself, and you'll be able to absorb the issues better.
Right, so I mean, that's a bit of a, will institutionalize restraint or will institutionalize moderation in some fashion. I guess in a competitive environment, how do you institutionalize that when the competitor may be doing one more than you're doing?
Well, you see that, the big area that everybody talks about today is in the leveraged finance market, that is it back to where it was. Mm-hmm. And the place it's not back to, if you talk to both the private equity players and in the lenders, is the leverage, the debt terms, the leverage in the deal is still held down. There's certain industries that can get up higher, but mostly it's held. So the covenant light stuff was never the problem. There's no correlation between covenant light that we could see. And we didn't lose money in that business all the way through the crisis, but there's no correlation. The covenant light wasn't the issue. The issue was when something was over leveraged, it was over leveraged. And so I think you've seen that hold. Now we'll hold for another 3 years if times stay better. I think it will, because I think, frankly, we're all more mindful of it. The regulatory environment's more mindful of it. The market's more mindful of it. But we've got to make sure that happens. All things in moderation is not something your grandmother told you. It's actually a Roman saying from that long ago. And we have to stick to that in our industry and frankly, on the other sides of our industry.
Yeah, and yet we've all found it difficult to institutionalize that moderation process.
You can do it through controls and stuff, but ultimately you have to have people think that our role is how our customers make money and to stay, to make sure things go on that will have real economic value at every turn.
In housing, kind of nearer term, we've got this nascent housing recovery, and you talked about interest rates are likely to move in an upward direction. How is that likely to impact housing and the recovery that we've seen in housing recently?
Well, you've seen a significant rise in mortgage rates that, so let's say it's a 100 basis point rise in mortgage rates. If you actually looked at it very pragmatically, on a $100,000 mortgage, 100% rise in interest rates is like $3 or $4 a day. It is not enough to really impact it in the move we've had. In the nominal rate structure, 4.5% is still among the all-time low mortgage rates, so it's still very constructive. In the end of the day, you know, the affordability is still really solid, so we think that that's constructive. We do have to be careful that the combination of the underwriting, which is pretty restricted right now, the rate actually pulls this thing back, but we don't see it yet, and we just got to pay attention. But I think the people, you know, the Fed and others on the other side are very worried about this issue. We've got to keep the housing recovery because of the confidence signal it sends to the economy in good shape, and I think everybody's mindful of that. But I don't think you've seen a rate rise, even though it's been dramatic. I mean, the rate rise that occurred is unprecedented, but it only rose to levels that are still unprecedented in the grand scheme of things. So it's kind of an odd juxtaposition to think that rates moved at a pace that hasn't been seen in our careers, yet they are still, you know, a 10-year treasury at 3% is still in the all-time, you know, tail level rates that have existed.
Right. Switching back just to what you've done since the financial crisis, are there a couple, 3, 4 points that you would say you know, and/or the Bank of America leadership team, specific decisions that you made coming out of the financial crisis or during the financial crisis that really allowed you to survive and ultimately be in a position to thrive again?
Well, I think the number one decision we made was just take the company, which had done 6 acquisitions in 5 or 6 years, 300,000 people, and we only have 250,000 people today. So think about that change, and all those acquisitions and all the work, and then a financial crisis on top of it. The question was, we had to pull the company back to what it does every day, which was everything we do has to be drawn back for the customers. So we got every extraneous business we could, and it was 60-some operating units. So we had a Canadian card business, number 1 card business in Canada, standalone card company. We sold that. $60 billion of private equity. I was telling John Canning, I think we're down to about 7. You know, and what all that did is took the complexity of the company down, built the capital, built the liquidity, and it just made the place easier to operate. But we didn't give up one customer functionality as we did that. So even something like the mortgage business, we withdrew from supplying mortgages to third parties who then supplied them to their customers and stayed the direct-to-consumer business. We have sized that business at a place where it is number 2 or 3 in the business, yet it's all direct to the consumer and doesn't have these indirect businesses in it, which causes most of the trouble. So the number one thing was get the company back to its roots. Simple way to think about that, we were $2.8 trillion at the peak, we're $2.1 trillion. We had about $60 billion in tangible common equity, we now have 140. So think about that change. That is from 09 to 13. This is not 10 years, and we issued about a billion shares since the beginning of 10 to accomplish that, and some exchanges and stuff. So that was really good. Get the company in, get the capital settled down, but simplify the place so that every ounce of energy you have from both talent and energy, systems, initiatives, capital, et cetera, is geared really what your purpose is, and get out everything else. That was easy to do. It was obvious, but it provided a lot of throughput.
As part of that downsizing of businesses, essentially, how did you decide, or what criteria did you use as to what you keep and what you jettison?
What the customers needed from us. I never had a customer come and say, if you're not in private equity, owning companies, I won't do business with you. I never had a customer say that. I never had a customer come up to me and say, if you don't provide a loan through XYZ mortgage company, I won't do business with you. And so you just had to say, what do the customers ask us to do? And so we got out of everything that wasn't core. And we still have pieces, we're still in the process. International wealth management, it's a business which is good for somebody, but for us it was a complexity factor of high order that didn't make any money on $1 billion of revenue. So, it really came down to that sort of watchword, which if a customer needs us to do it, we have the number 1 or 2 or 3 position in every product for both people, companies, and institutional investors across the board. There's not a product where we don't have a top shelf capability. But we had a lot of other stuff at the same time that really didn't serve those customers. So it was really around that principle.
So you mentioned just right at the time of the financial crisis, you had just completed a series of significant acquisitions and stuff, some of which didn't work out as well as hoped. Are there lessons, good and bad, that you learned from that series of acquisitions?
I think, you would have said go back and not do some of them in aftermath. That's easy. Are we a better company because all the capabilities we have? Yes. But the reality that I face as an operator, and Hugh McCall, who was my predecessor before Ken, and, I was talking the other day, and we were talking, the company that my team manages and the company his team manages are completely two different thought processes. He had to accumulate a company that could actually be around, survive and participate in consolidation. We can't make any acquisitions, so we have to be an organically driven company or else we just won't exist. So the interesting juxtaposition, yet I spent my whole career helping CEOs like Hugh do this stuff, and now we run a company that's different. So I think whether the acquisitions are good or bad is not the debate. I have the responsibility of taking what's built, taken 230 years to build, through all the different pieces, and put us in a position no one else's is. I have an obligation, the team has an obligation to drive that for our customers and shareholders forward. It has nothing to do with the acquisitions. We can't do them, we won't do them. So it's kind of an interesting exercise. There'll be books about it someday. For me, it's just what do we have to do going forward, or else you can spend a lot of time about something that's not going to be that constructive.
Let's switch gears a minute and just maybe talk about regulatory environment, some of the politics around it, even some sort of the too big to fail questions. Recent months, I think everyone here has seen, you've seen Sandy Weil, most recently John Reed, who are architects of the demise of Glass-Steagall, call for the reinstatement of those old Glass-Steagall rules and essentially the breakup of the large banks. Are they wrong?
Well, let me tell you how I think about it. I ask, if you ask a customer what they need from us, and let's say it's a $2 billion company or a $500 million company, they need us to provide working capital, they need us to provide cash management services, and then they need us to provide access to capital markets. And in order to provide access to capital markets, we also have to be able to engage with investors to help connect investors in our companies. These businesses are the business model everywhere in the world but the United States, or have been forever. And so the idea that somehow separating lowers the risk, when the risk was actually caused by the separated parts in some context, is kind of not the right answer. The customers need it this way. Then the question is, I got to have the liquidity, I got to have the regulation, I got to have the capital, and I think that's the place to focus. If you take the old securities powers, so to speak, and put them outside, you just end up with the same problem in a smaller enterprise that doesn't have what we have. So we have $220 billion of common equity, $140 billion of tangible common equity. We only have about $30 billion in the securities business, in the markets business. If you were on your own, you'd have $30 billion of equity, and that's all you'd have, and your volatility of funding and all that stuff. So it's a more stable environment if, as you said, kept in moderation. So I'm not a proponent because the customers don't want it. It's not good for the shareholders, and frankly, it won't be good for the system because all the volatility that was taken out by having these companies absorbed by JPR cells or Wells will be put right back in the system.
So with the prospect of the Volcker rule eventually getting into place, should banks be allowed to engage in proprietary trading? Or
we got out of the proprietary trading in second quarter of
and market making versus prop trading. How do you tell the difference?
Yeah, that's what's left to be written. And so if we're doing a financing for a municipal, the city of Chicago or something like that, one person's, we buy the deal and then we sell it down over time to the investors who invest in tax-free deals. That's the way the world works. It takes you some time. And so, if you define it to be an afternoon, then you got everything's defined to be trading. If you define it to be a reasonable period of distribution time, I don't think there'll be a problem in the business model that we operate, and frankly, all of us operate. The lesson learned is the capital rules are so, it requires such capital intensity that anything that has duration to it in your balance sheet, that it's taking care of itself before Volcker ever gets finalized, honestly. It's just too capital intensive. That's the private equity thing.
So generally the whole Dodd-Frank's rules formulation, there are hundreds and hundreds of rules that have yet to be formulated.
Right.
How do you run your business against an environment where it's essentially unknown what the rules are going to apply to you tomorrow?
Well, it's not fun on a given day because you're not sure what will come tomorrow. But I think if you look in the principles that are there, capital, the Basel rules across the board, there's enough clarity that you can work the company into the structure, and we have been. Proprietary trading, again, got out of that earlier. Private equity investing, we started downsizing that. There's still work to do around some of those definitions, but I think the principles are well understood enough that most of us include, Bank of America and any other peer institutions have been moving along this path, knowing that you might as well get out of stuff or leave rather than have it come at you. And I think there's still some work to do that will happen around commodities and some other places as the rules get finalized. But I don't see as huge impact to the business model. There will be a question on the other side of it is then once you sort of figure out here's the equity, here's how it all works, how the pricing works out to the customers will have to iron out, because ultimately we have to make money on the business and the customers understand it, because if we don't, we can't provide it, and it's needed services. This isn't proprietary trading or something. This is now making a market or entering a derivative trade for either for a hedge fund or an insurer to hedge their interest rate expense that you need. So that'll work out. So you just look at the principles and try to build a company into them, and once in a while you get surprised about the rules. But most of them are pretty clear. But the rules, the devil's in the details. And even the rules that were set under Dodd-Frank, some of them are getting overturned, and you got to go set them again. So it's not. We have 270 people working nothing but capital at our company. Just to give you a sense, we have spent $150 million on a resolution plan. It's 2,000 pages long. It's a lot of work, but on the other hand, the principles are there.
Right. So, let's talk a little bit about technology and maybe the future of banking. We had Eric Schmidt from Google here last year talking to the same audience. A question that was asked there of him was, there are 1.7 billion people who do not have a bank account but have a mobile phone. Will Google be the next big bank? Will they be a competitor of yours one day?
I mean, we're all in the information business, so I assume we're competitors today. But let me get it out of the question of either or, but get a question of what really happens today. So just to give you some background, we have about 13.7 million mobile-enabled customers today. Before you have lunch tomorrow, another 7,000 or 8,000 will sign up. Before you have lunch tomorrow, 100,000 checks will get deposited by people taking a picture of them on their smartphone and sending them to us at Bank of America. So this is not something that's out there. This is here. You could not have a check deposited through a smartphone in August of 2012, and it's up to 4% of all the checks. So that's what's going on. Now, on the other hand, we have 8 million branch visits a week. So the people still use all the capabilities we have. We have hundreds of millions of phone calls a year. We have 30 million computer-based customers. And that's just on the consumer side without getting the business banking side. So it's all happening. So we're all going to be competitive along that. The untethered technology that the smartphone, iPad, tablet represent is a sea change in the way we can interact with customers. So another thing we do is we send out 20 million text messages or emails to customers on a monthly basis saying your account's below $25, don't do anything until you fill it back up, right? 22 million a month to 6 or 7 million customers. What that helps them do is manage their cash flow.
I got one of those the other day.
That should. You'll get one tomorrow too. But you help them manage the cash flow, because I don't want to embarrass anybody, especially if they're accounting fraternity in the room. But I bet you nobody bounces their checkbook anymore in this room. They look at the statement to make sure the transactions and the way it goes, right? So effectively, what's happened for people that have less balances, we are balancing their checkbook at real time by sending them a note saying you're getting close to the edge. So the mobile untethered computing power is here, and so it's real. And so yet you still have tens of millions of checks come through our system a day. You still have the biggest payment medium is still cash, and so we dispense $250 million in 20s out of our ATMs on a given day. So the idea is you have to have all that, and that's what's interesting about this. So I don't think there are niche plays around pieces of it. We send $2 billion of payments off mobile phones a week now, but the reality is it takes an integrated whole, I think, to really be competitive. So Google may be a competitor, but if they have a bank charter, they'll be a bank holding company, and I'm not sure that would be interesting for them, let's just say that. But could they be an enabler for somebody like us with wallets and stuff like that? We do that all the time with them. And so the technology versus the actual providing the banking service, I think will always have some distinctions to it.
So with all this data and all this information and all the banking services moving to the cloud and ultimately to our tablets, mobiles, that kind of stuff should be weird from a privacy standpoint, from a hacking standpoint. Are accounts safe?
They are safe, and we spend hundreds of millions of dollars a year to make sure they are. But it's something that we work on every day, and it's something that actually is a barrier to competitors, because I often I often talk to people who have some startup kind of financial services company, and their revenue in their wildest dreams doesn't equal what takes to actually protect your systems. And so that barrier is real, but it's right. We should have that burden to protect it, because at the end of the day, trust is what our industry relies on, and we have to protect it, and we should protect it. So it's not it's just a cost of doing business. With our scale, we can put it across the platform, but it is, I wouldn't be worried, but I as a provider, we have to be worried, so you aren't. That's what we have to do.
You touched on it a little bit, but as the younger generation emerges, the millennials, are their banking needs as consumers going to be different from old folks like me?
I won't call you old, because that would be.
I did graduate from college before you did.
I know he got me by a year out of Brown, so they're definitely different. But I think the sort of the view that people our age or older, my father's age is 85, don't use the mobile servers and stuff is not right. The adoption rate is different, but it's across everybody, online banking and stuff. And so, is there a faster adoption rate among young people? Yes. I think the issue is less about technology and more about their attitudes. And the kids, my kids' age are growing up with nationwide consumer financial services banking brands. That didn't happen for any generation before them. So they can be a Bank of America customer, in Charlotte, North Carolina, and in Chicago, Illinois, and San Francisco as they move around the world. That's a different element. So one of the places I get a lot of chin music is when friends' kids go to college and we don't have branches, and they say, why don't you have an ATM at this college? Because my kid's paying foreign ATM fees. You're sitting there saying, that would have never been asked 20 years ago because the expectation wasn't there. But the expectation is, that I think is much different. We're big brands. We're brands that are national in scope, and that has the benefits, but it also has the care you have to take of financial services brands in the future is going to be absolutely critical. And so I think the millennials are going to be, their business is going to be all about that. The people before them, it was more geographic and more local bank and more of that stuff. That is gone for people coming into the system as we speak.
Let's talk a little bit just about leadership at the bank and the culture of the bank. You were a recovering lawyer who became a banker. Did that career trajectory inform your leadership style in any fashion?
I mean, I've been out of it a long time, except for a short, eventful period in 2008. But law school is a great education. When people often come and ask me, should I go to law school? Should I go to business school? And I say it's not really important unless what career do you really want? But I think law has a great ability, and there's a lot of CEOs that. When I sit around the table we have a group of 8 of us in the Financial Services Forum. I think 5 of us are lawyers, and it's just because it taught you how to think, and it's different in business school, which also teach you how to think. So I think it was great training that way. But in the end of the day, what I learned from my clients as a lawyer, and then what I've learned in business, about business strategy and stuff like that, I think is the education is relevant to what I do today. It doesn't hurt to have a legal background when you're paying $1.5 million a year in legal fees to try to understand what you're spending it for, but that hopefully is transient at best. So.
And how about leadership lessons, transition from the financial crisis to now? We really had to deal with a whole different set of problems through the financial crisis, and you've got those behind you. You've got a growth strategy now. Has your leadership style changed, or are you adapting to a kind of a new environment from a growth versus let's fix all the problems?
The fix the balance sheet and those stuff was impacted all our teammates, but the teammates in the field had just been out doing their business every day and competing in the market. And so middle market teammate here in Chicago is out banging against the market. He or she is banging against the market, against the competition. So their life, one of the things I always bristle at is when the analyst or a shareholder says, now you're done with that, Brian, now you can concentrate on growth. The answer is, we've been winning market share in these businesses for the last few years. We have the number 1 wealth management business in the world. We have this, that, So it's not like these people have been sitting on their hands waiting for us to figure out what to do. And so that process. So one of the key issues actually is to keep all the energy of the senior team that went into fixing things and not let them get in and screw up a lot of the business work that's going on and kind of keep them away from it, which takes a little bit of a care because you've had a lot of what we worked on has gone away. And on the other hand, I think the luxury that we now have with the idea that we can't do any acquisitions and won't, that we have 3, 5, 10-year horizons that we can think about gives us the ability to plan in the future that we didn't have in really the company's history for the last 10, 15 years. And so that's the cultural change we're going through.
So you talk about the culture change. I mean, you've got a global financial, I mean, you've got a global base of customers, clients, teammates, retail clients, global financial institutions, global companies. How do you build a culture internally at Bank of America, and what kind of culture do you have that holds you all together?
Well, we build it off of, you build it off an understandable set of principles, or the values, to the purpose, to the strategies, to the operating principles, and we have that. And so when I had the team at the Institute this morning, I took them through the same discussion. We have the 4 values, we have the strategy, what we do. They are tired of hearing it, and I'm sure those CEOs out there know the amount of times you have to repeat yourself to make sure, because at any given moment, 5 or 10% of those people that are sitting there today weren't there last year, and so you just got to keep that going. And a way to do it, I believe, is then, when we have our KPIs or goals, they are by the operating principles, and so you unify the company, even though they're very different businesses and have very different attributes, around the common themes, and then drive at that. And so, the culture doesn't, you can't sit there and snap your fingers and say our culture. Culture is how you make the important decisions, I think, and lay it out, and then people migrate to the culture, and if they don't, they leave. And so we've taken multiple cultures and taken the best parts, I think, and we're still in that process. But I think what has happened is that people who couldn't live with a culture that was built on teamwork and built on the principles of our company, they have left, and now the people going forward are just out there killing it every day for us. But it's all around that, basically we have a purpose, which is to help our clients and customers live their lives. It's not about us, it's about them. It's about the clients and customers. And if we don't get that right, then people can't survive in our culture.
Bank of America has made a strong commitment to social responsibility, and I referenced in my introductory remarks that you've got aggressive goals in the areas of community development, philanthropy, and environmental initiatives. Why these initiatives? Why now? Do they have a value in the global marketplace?
Well, it's all built around, we're going to represent the communities we serve, and the communities have a broad context. The international business community, because our global corporate investment bank serves large companies around the world. The Chicago community, as I described earlier, because we have a core banking and wealth management presence in a city like this. So we do these initiatives because they're not only the right thing to do, and our teammates like that we do them and they participate in it, but we do them because they're consistent with our need to help be that bridge between our customers and clients and the capabilities and the communities. So we'll have our teammates will do 2 million volunteer hours this year. Up from 1.5 million last year. Less teammates, our head count's probably down from 280 to 250 some thousand this year, and more hours. And so this is just who the company is and part of the culture, and it's the right thing to do, but also it's in our best interest if they're strong communities. And so, why do we do that work? We have the 150 to 60 houses that we've, in Chicago, have moved out of abandoned housing places, because it helps those communities have less abandoned houses. It's that simple. That will make it a better community, and ultimately, financial services companies will reflect the economies they serve. We can't make an economy. What we can do is help it happen and facilitate it, but we're going to reflect it.
Sort of related, you're chair of the bank's Global Diversity and Inclusion Council. Why is that important to you? Is it good for business, or is it just because it's a good thing to do?
Both, because at the end of the day, in order to have the talent you need to be competitive, you simply have to have a place where the teammates that work there feel that they can be their best. And anything that gets in the way of that is very difficult and ends up in a lot of, just not good place. And so we call it diversity and inclusion. So we have great representation statistics, but the question we really focus on, and we have an index we measure across all the businesses and all the different groups, is we focus on a simple thing that an associate said once that we've used as sort of our mantra. I want to be able to come to work every day and bring through the door who I am and not have to leave it there and pick it up on the way home. And if you can do that, you can uncork everybody's talent. And you can't leave that to chance. You have to measure it and push and make sure people have it, because we are dealing in our industry with pockets that have traditionally not been that open, and we're opening them up. And so we're very proud of all our efforts. We're recognized by everybody in the world. Our scores, would rank next to everybody's, but the reality is we got a lot of work to do here, and so we concentrate in a lot of different ways. I chaired it before I was CEO, I chaired it after I was CEO, but we run it through 25 or 30 talented people, but what we really do is run it through all the businesses. And it's just wonderful stuff to see. When you go to Hong Kong and see the chapter of the Pride network that we have in the company and see how active they are, or go to London, it's just something that knits the place together. It's really fantastic.
You mentioned some market presence here in Chicago. You've had a long market presence here, dating back to Continental Bank, LaSalle Bank, other entries into this marketplace. How do you view your footprint in Chicago in terms of the types of business that you have, your market share, and where do you want to see that going forward?
Well, we have, this is a bit of a unique market in that we have not only all the traditional businesses we'd have in a lot of markets, retail banking, preferred banking, wealth management, U.S. Trust, Merrill Lynch, wealth management, commercial banking, middle market banking, et cetera. Here we also have investment banking, John Pratt, Todd Kaplan, and teammates, and we have sales and trading teammates that support the sizable investment management community here in Chicago. So all our businesses are here. We have 7,000 people. Is our market share where I want it to be? Never. And that's Tim's problem, so he can, we measure. But the reality is the team out there investing every day. We added 30 small business bankers because we thought that we'd not serving that 2 million and under revenue company well, so we added 30 small business bankers. We've added mortgage loan officers because after countrywide we had to reset that business and bring it back. And so we'll keep deploying resources in a market like this because it's a fabulous community, a fabulous market, one of our biggest. And frankly, the opportunities, this market's in better condition than most of the United States, so it's great for us. But Tim's got to get his work done.
Somebody's got a new assignment. Easy question. Who would you like to see as next chairman of the Federal Reserve Bank?
I'm trying to.
And if that's impolitic to ask.
No, it's impolitic to answer, not to ask. You could ask anything you want.
So what do you see as relative strengths and weaknesses of the two?
That's even worse. The big concern is if it's X or Y, will something change? I think what I would think is you think about the dialogue around the Open Market Committee and how it's actually narrowed. So I think there's a pretty good consensus around the Open Market Committee about the right way to do this. There was a little bit more beefing a year ago or 2 years ago that, should we get out of QE, should we do it or should we not do it? I think that's kind of out of the system now because everybody agrees we should get out. The question is how and when and what indicators we're going to use. And the transparency that Chairman Bernanke has had is unprecedented in the Fed, and you can see an article today sort of saying, will the next person stand up to this and keep it, or will they start to get more quiet? But I think anybody faced with the facts, which is the largest economy in the world by 2.5 times, that is growing at 2.5%, that it still has a 7% unemployment rate plus, you've got to be accommodative. And by the way, there's no inflation risk you see out there, and I was asking some people at breakfast this morning, do you feel wage inflation? No. The commodities prices bounce around, but there's not a real inflation risk. So I think anybody in that job will be faced with a clear issue, which is I've got to keep this thing moving forward and keeping that runway paved ahead of this airplane so it can take off. Because if any other alternative, you don't know what the outcome is. And Japan has been a good lesson in that. But remember, Japan is a much smaller economy than the U.S. The world depends on this economy. So the consumer spending that goes on in the U.S. drives the economies in the world, not just the U.S. economy. And so if the U.S. goes backwards, that's a whole danger. So I think anybody faced with that will keep it. I just think there's going to be a lot of market perceived differences in people that won't be really there when you really shake it out. Like all these jobs, like becoming a CEO of a major company, like becoming the chairman of the Fed. Once you're in the office, it's a sobering thing to sit there and say, I got to think this through. And I think that was what the data and the facts will prevail.
Did your personal circumstances growing up, you were the sixth of 8 children, a large family, did that prepare you in some unique way to become CEO of a large bank?
As I always tell somebody when they're trying to out-argue on a point, said I've got a lot of practice at this. I think I became a lawyer and a history major in a scientist household. My dad was a chemist, my brother's a biologist, computer scientist. So I was a black sheep, so that always gave you a little bit. But I think what I learned from my family and my brothers and sisters was really how to see how all kinds of personalities in a group that large can get along. My dinner table would have looked like this on a given night. So, and so I think that it's the values your parents gave to you, how you think about life. yeah, those are important things, and your brother and sisters impact that. But they've been very supportive. It's not, you know, they've been very supportive in everything I've done. But you know, if you said you are who you are because how you grew up, I'm not sure I'd point that if there's 7 kids that would have been different than 8. That you were unnoticed in number 6. That was always good for causing trouble. But other than that, it was.
So just reading about you before, prepping for this, a number of people refer to you as ridiculously hardworking. What does that mean?
You know, I'm not sure. I would, you know, I enjoy this job. And do we think about it a lot? Yeah, because I think we have 250,000 people that I take extreme responsibility to make sure every day I do everything I personally can do to help them achieve what they need to for the, you know, the clients and customers they serve. But we're all hardworking. I think that's become, you know, sort of a way that it goes on. But, you know, to me, the question is how do you balance it, and how does it work for you as a person? I get asked this question by teammates: how do you balance work-life? And, you know, I think we're all hardworking, and the question is how do you balance it, and how do you make sure that you can survive? That, you know, these are, you got to be able to do this job for a duration, and you can't kill yourself in the process, and that's one of the challenges. How do you think about doing it across a decade across, as opposed to across the next month? Because the demands are high, but that's what, you know, that's what you sign up for. And so I was ridiculously hardworking by that definition probably when I was a first-year lawyer, but I'm not sure it makes a difference. It's just you want to be successful.
Brian, thanks very much
Thank you.
for being here. On behalf of the Economic Club, we appreciate the time you spent with us and your remarks. It's been terrific.
Thanks
very much.